Investing in real estate rentals has long been a tantalizing dream for many. And this is because the allure of passive income, property appreciation, and the potential for financial freedom often paint quite a rosy picture. Yet behind the scenes, the reality is the journey of the real estate investor is far from a seamless path to prosperity. And of course, while there are undeniable benefits to owning rental properties, the reality is that it can also be full of stress and periods of unprofitability. And this is just if a few things go wrong. Now in this video, I'm going to go over exactly why I recently sold one of my real estate properties and why I decided with the money to invest in 3 different high quality REITs instead. Now we're going to go over each one of these 3 REITs and I'm going to explain to you why, in my opinion, this is a much better investment than that of holding on to my rental property. Now stick around if this interests you because we have a lot to go through. Right after you, please drop a like on this video and subscribe for more future content like this. So maybe for the newer investors that don't even know what a REIT is, a REIT, or REIT, is a real estate investment trust, and it's basically a company that owns, operates, or finances income-generating real estate. So what a lot of these REITs do is have a company that owns real estate, and then investors invest into the company. And as the REIT gets bigger and bigger, they continuously acquire and manage more and more real estate. Now, of course, when it comes to real estate investment trusts, like pretty much any other investment out there, there's higher and lower quality REITs out there. Now, the 3 different real estate investment trusts that we're going to go through in this video, in my humble opinion, are all extremely high quality. And if you want to learn even more about any of these different REITs, I have made more extensive videos on my channel, so make sure to check those out. So first, a quick little backstory. I did as of recently sell off one of my real estate rental properties, and I decided to do so for a few reasons. For one, the real estate property value went up pretty substantially and was still holding some decent value even with the situation of interest rates skyrocketing as we've seen recently. Now, of course, I can't tell the future. I don't know what's going to happen with the value of homes, but with a 30-year fixed mortgage rate currently being at 8.107%, I felt like it might be a decent time to sell off one of my rental properties, take my profits, and move the money into 3 different high-quality REITs. Now, another reason on why I decided to do this is because the real estate sector in the stock market, REITs, has really been beat up over the past year. If you look at the Vanguard Real Estate Index, it's down almost 20% just over the last year. Which of course means that some of the highest quality real estate investment trusts out there, things like Realty Income for example, are also going to be down substantially. Realty Income is down 23% over the past year. Now, the final reason I decided to sell off my rental property and invest the money into REITs instead is because the management of the property started to be sort of an inconvenience. You see, what most of the real estate investors don't want to tell you is how much maintenance and how much headaches actually go along with owning properties and renting them out to tenants. And the reality of just one maintenance call, meaning that you don't make any profit after the rental income for that month alone. So for the reasons of interest rates being sky high, the management just getting quite annoying and unprofitable, and of course the fact that the real estate sector in the stock market is very cheap relatively speaking, I decided it was time to sell off my properties and buy into these 3 different REITs. Now the first REIT I bought into was none other than Realty Income, ticker symbol O. Now if you're not aware, Realty Income got its start with a single investment in a Taco Bell. Today, the REIT owns thousands of properties across America that are leased to hundreds of tenants operating in dozens of industries. Now, all of Realty Income's properties are under a long-term triple net lease agreement, which means that the tenants pay for things like maintenance, utilities, and even taxes. Now, impressively, Realty Income has paid uninterrupted dividends since the firm's founding and has increased dividends each year since going public in 1994. But stay tuned because we are going to look closer into the dividends in a little bit. To look a little bit deeper into Realty Income, going on the website, they have over 13,100 commercial properties under the net lease agreements, a 99% portfolio occupancy, which means basically, for the most part, every single one of their properties are being leased right now. Over 1,300 different cities in 85 different industries. This is a high quality REIT that is heavily diversified. Now, what's also crazy about Realty Income is that a lot of us actually step foot in Realty Income's properties, a lot more than we probably even realize. Realty Income leases to companies like Dollar General, Walgreens, Dollar Tree, 7-Eleven, Wynn Resorts, FedEx, LA Fitness, and many more, just to name a few. Now, this right here is maybe one of the most bullish aspects of Realty Income in my opinion. It's the fact that the property diversification type is made up of mostly retail. Now, especially knowing the type of tenants that Realty Income leases to. These are tenants, these are businesses that are going to be around, whether the economy is good, whether it's bad. It doesn't get much better than leasing out your properties to recession-proof businesses. Now, like I hinted at earlier, Realty Income, for example, is almost at a fresh new low on the 52-week range, with 55.50 being the low and 74.82 being the high. Realty income, currently trading at under $58 per share, is giving investors a starting yield of around 5.3%. Now, for any real estate rental property owner out there, a 5% return on your money is actually pretty good. And this is especially when you take into consideration things like future dividend raises ahead. And of course, the possibility of realty income once again trading in the high 70s or even $80 per share sometime in the future. That's sort of just a bonus on top. The next REIT that I've been buying shares like crazy of is National Properties, or ticker symbol NNN. Now keep in mind, a side note, I've been spending most of the proceeds on shares of Realty income, and then some of the money on NNN and some of the money on the next REIT we're going to go through here in a second. But for those not that familiar with ticker symbol NNN, National Retail's roots trace back to 1984, when the restaurant chain Golden Corral formed a REIT to acquire its properties and lease them back. The REIT was advised by National Retail's predecessors and provided an investment vehicle for Golden Corral employees. Nowadays, National Retail owns tons of different properties across America, and they're leased to over 350 tenants in over 30 different industries. Now, National Retail is also down almost 20% over the last year, and is trading very, very close to that 52-week low of $38.05 per share. Now, with exactly how low ticker symbol NNN has been trading as of recently, the dividend yield forward is around 5.81%, which is even higher than that of Realty income. Now, National Retail doesn't pay a monthly dividend. It does pay a dividend quarterly, which, to be honest, is kind of the same difference. But I'm super excited to be dumping a ton of fresh capital into National Retail and owning shares of this instead of owning that rental property moving forward. Now, the last REIT that I've been buying shares of like crazy ever since I sold my rental property is ticker symbol WPC, or WP Carey. Now, WP Carey was named after the founder and formed in 1973. It's a diversified REIT specializing in single-tenant commercial real estate, with over half its properties located in the US and most of the rest found in places like Northern and Western Europe. This REIT was an early pioneer of the triple net lease and sale leaseback, a business model that it still uses today, and a business model that many different real estate investment trusts use today. Now, WP Carey is down the most year to date out of all three of the REITs that I've been buying. It's down 26.94%, and it's basically right at the 52-week range low at $64.04 per share. But what's absolutely crazy is that it wasn't all that long ago that WPC was trading at $84 plus per share. Now, with how beat up this stock has been, it's giving a starting forward yield of 6.53%. with 12 years dividend growth, which means that in theory, if you hold on to shares of WPC, National Retail Properties, or Realty income for that matter, they all have a history of paying more and more and more, at least historically speaking. So there we have it. Those are three different REITs that I've been buying like crazy ever since I sold off one of my rental properties as of recently. Now, I'm by no means saying that buying into REITs is better than buying and holding onto physical real estate or vice versa, but I do think that there is an argument that buying high quality REITs at cheap prices and holding onto them long term can in some cases be just as profitable and a lot of times way, way easier than buying physical real estate out in the world. But I want to hear from you guys down below. If you could only hold on to REITs or physical real estate properties, for whatever reason, which would you hold on to long term and why? If you enjoyed this video, make sure to please drop a like down below and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.